Good morning and welcome to Earnings Edge right here at NDTV Profit. We're now taking stock of SAMIL and Motherson on the back of their Q1 earnings. The company reported a strong 29% revenue growth in this particular quarter, followed by 44% growth in EBITDA, as well as a strong beat on PAT, up 69% compared to the same time last year. To discuss more about the results and the outlook for the company as well as the industry, we're now joined by Mr. Pankaj Mittal, the Chief Operating Officer at SAMIL, as well as Mr. Kunal Malani, the CFO at SAMIL. Gentlemen, thank you so much for joining us today. Just wanted to start with, the first quarter. How has the quarter been for you? We've seen, really strong revenue growth and that translating to profitability as well. And margins have been just shy of the 10% mark. How would you just assess this particular quarter for us for financial year 2025?
See, we would say that yes, the performance was really very good, and and it has to be seen in the context that the global automotive industry remained flat, despite the growth and also the large M&A payouts, also doing growth capex, our leverage ratio has been maintained at 1.5. This financial prudence also resulted in ratings upgrade in this very volatile world by Moody's, Fitch, CRISIL, and also a first-time rating by Japanese credit agency, which gives us a stable rating. So we see continued investments in our future growth capex. Two of our facilities are commencing production. 17 new greenfield sites are under different stages of completion. So the growth is coming from the developing economies, while the developed economies see this flattish or slight sluggish growth or a bit of softening of demand like in Europe. It's been a bit more volatile in terms of the powertrain, whether it's ICE, hybrid, or EVs. So there has been kind of confusion in the market and it's getting stabilized. But Motherson is powertrain agnostic. So we have a very good, strong point that our products go to every different vehicle which is there. We also see that the trajectory in the world market is towards premiumization, as well as SUVs growing all across, which is also helping us to grow. So on an overall basis, we do see ourselves as a very strong growth engine in this market, and also the growth of the company into the non-auto side gives it much more strength for growth coming in the longer duration.
You didn't mention that, SUVs, I think in the previous quarter as well, you pointed out that most geographies are upwards of 40%, while some geographies like North America have seen SUV penetration of upwards of 52%. Before we get into the business, I just wanted to, question on, the P&L impact of any kind of acquisition. Last quarter, you had pointed out that for Yachiyo, Lumen, as well as ADI, you might see some impact in Q1. Margins have also come in while higher by about 100 basis points compared to last year. It's just shy below the 10%. So have you seen any particular impact on margins for acquisition in this particular quarter? And how would the outlook be for margins going forward as well?
So like you always know, we really do not guide about margins, but let me put the right context to this. You're right that there is a 100 basis point improvement versus the previous quarter. So from 8.6, it's moved to 9.6%. It is shy of 10%, but it is actually higher than the entire year last year. Last year's entire year margin was 9.3%. We are in the first quarter itself sitting at 9.6%. So that's the context on why we think all the M&As have been margin accretive. The total M&A, let's say revenue pool that has been assimilated in this quarter is just slightly above 6,000 crores. And the aggregate margin accretion has happened on account of the M&As, together with considering that there are integration costs, etc., that have already got embedded. So, the 9.6% should be seen in that context. Now, as we move through the rest of the year, while we really do not talk about the margins, but if you look at the ROCE, our ROCE has improved to 18%. And directionally, we had highlighted last time as well that we should be improving on an year-on-year basis going ahead, and we should still be seeing an improvement in the ROCE as we move through the rest of the year.
Just coming to the debt levels, while just slightly up from the last quarter, it's maintained around the 1.5 times, and this year you're going to see a lot of capex intensity from the company as well. 1,000 crores already invested in this particular quarter. I think if you can just reconfirm, the number was 5,000 crores for this year as a plan to invest across the verticals. But my question was more on the revenue growth we've seen in verticals now. Modules and polymer has grown by upwards of around 27%, and emerging business, of course, growing by 40%. The rest have seen a high single-digit growth. Is this the kind of, like, while you can't confirm, like you can't quantify it, but do you see this kind of trajectory going forward as well, especially with what the commentary you've said on Europe being a slightly slow, and the production volume also you've called out in your presentation being slightly lower, with EVs also going at a slower pace than thought of before. So how would you see these particular things going forward?
So look, firstly on the debt, let me clarify. You're right, it is 1.5x. The capex guidance remains 5,000 plus minus 10%. We may need to recalibrate this given this was done at the end of last quarter. In this quarter, we have already got 3 new businesses, which is Lumen, ADI, as well as Yachiyo coming in this quarter. So we will have a relook at the capex given the increased business perimeter that exists. Together, we have also announced 1 new greenfield in Mexico. But in spite of this, I still hope that by the time we come in next quarter, we should still be in and around that 5,000 mark. Having said so, on a full year basis, we are still guiding towards a deleveraging path. We should still expect that the leverage ratio from here will further go down. Hopefully closer to the 1x, if not beating the 1x as well. This is obviously with the current business parameter, and things could evolve as M&As happen if it happens during the year. To your point on growth in emerging versus module polymer and so on, look, number one, if you look at our capex, you are seeing now 17 new greenfields in play, 19 actually, 2 have just commenced, so 17 is now remaining. 7 of them are in the non-auto. And if I look at emerging as a whole, nearly 50% would be coming on the emerging businesses space. While all of them are in emerging or developing geographies, 50% of the capexes are coming in the emerging space. And hence that part of the business will continue showing disproportionate growth, if I were to put it. The rest of the business will have a reflection of how the business profile moves. What you saw in the current quarter is also an impact driven off EVs in terms of the sluggishness that you're seeing in Europe specifically. A lot of it is driven by sluggishness in the EV space. We actually continuously see an improvement or an enhancement in the ICE programs or elongation of the ICE programs. Hybrids continue to do well. It's probably right now the highest growing segment. So being a power agnostic play, it really over the medium term does not really make much of a difference to us as long as the volumes play out. And in the short term, we will continue to work with the customers to alleviate any pains that may have happen on the way.
Just one follow up on what you mentioned on hybrids being one of the highest growth engines. Is there any particular economy or region that's doing especially well for hybrids? In context that you are a global player, do you see a lot more action on the North America side for hybrids specifically? And if you could, I'm not sure if you give out this number, EV as a percentage across the businesses as total revenue, will it be upwards of about 20 to 25% in that similar range as well?
So EVs right now would be around about 9% of our sales, give or take. Hybrids actually as a let's say powertrain seems to be catching a lot more action in pretty much every part of the world right now. Given people who are thinking about transitioning back from EVs to ICE find this as an alternate. People who are thinking about moving from ICE to EVs also find hybrids as an alternative. So that does seem to be the flavor of the season, if I were to put it.
EVs at around 9% and hybrids, any kind of range. So would that mean that the alternate powertrain business, any kind of range that you can give us?
Don't have it offhand, but I would say we actually calibrate it along with the ICE because hybrid is a combination of the two. So we do not track it separately per se.
Now, just one question on the emerging businesses. We've seen, we mentioned strong growth as well as being very margin accretive. We've seen a lot of growth in that aspect as well. Just your presentation on the emerging business, just had one question on that. You've seen that a consumer electronic business has made its entry now in. It's a component business. You mentioned a growth driver, and you're also investing roughly 2,600 odd crores in this over a period of time. Could you just talk us through this particular business opportunity?
As you saw us pivot into many different areas in terms of 3C Extend. 5 years ago, we announced our foray into aerospace, health and medical, logistics. So these new areas came in, and they came in at the behest of our customers from different industries who saw very strong manufacturing base in us. Similarly, these are the opportunities which are coming into the consumer electronics sphere, where we are partnered with an accomplished player who's our joint venture partner, and we would be building the products for this industry. It's a wide scope in this industry. There is a lot of players in the world are now de-risking the supply chains, not just basing in one geography, but into multiple geographies. So the plus one strategies, and that's how we see it phasing in very well and poised to grow.
Is there any particular segment that you will be targeting now? Of course, the JV has come into play, as you mentioned, and capex plan also on way now. Because we've seen like certain companies have a more engineering preference for this particular kind of investment or an industry. Would that be something similar that SAMIL would be following for this particular investment?
It is actually a testimony of our engineering capabilities. I mean, the whole joint venture came into being because of our engineering capabilities that we have, done for the last many years in the automotive space, and then on to some of the other health and medical and aerospace areas. So, looking at the good work, I think this came as a testimony where the OEM had approached us, or multiple OEMs had approached us to consider this space, and that's how these investments have come into being.
Final question, sir. Just going forward as well, to end the question on margins, we've seen most of your verticals have seen margin accretion in this quarter. Actually, all of them. We've seen Vision System also have a 10 basis point increase. Where do you see the trajectory of these margins for this particular year? Because we've seen some cost pressures having on basis of aluminum and other commodities as well. Will you be maintaining this kind of performance that you've shown in Q1 as well, showing roughly around 100 and 150 basis point improvement for the whole fiscal year of 2025? And you didn't mention on capex that you will be revisiting that number. What is the kind of strategy on acquisition in this year? Will it be to kind of consolidate on this thing? Because I know that you mentioned before that acquisitions are just what comes to you directly and not something that you plan. Will that strategy be going forward as well?
For the latter, absolutely yes. We've always been a reactive piece in there. So we'll react to the set of opportunities that the customers give us. That way, we are making sure we're also looking at only the relevant set of opportunities rather than every opportunity that comes our way. In the context of sorry, I'm forgetting the
question of margins across verticals.
Yeah. Look, on margins, we've again said we do not guide on margins, and I wish life was a static piece of just looking at future equal to history. But I think going ahead, you would see that Q2 has traditionally been a weaker quarter, just given that there are summer shutdowns that happen. So the production levels are obviously much lower in Q2. So that's just a cyclical behavior of the industry. Q3 and Q4 turns out to be much better. And hence, if you look at the full year, we do expect that our ROC should be on an improving trajectory. As I mentioned, we are at 18%. We should head higher from it. Our target is 40. As you know, this is the last year of a 5-year plan. And ideally, we would want to capture as much of that difference between 80 and 40 as we can. So that is where the focus of the team is. And frankly, there are multiple levers. I mean, margin is only one part of the lever. There's a whole part of the other lever in terms of optimizing our capital deployments and hence try and maximize the ROC as we move through this year.
Well, Mr. Mittal and Mr. Malani, thank you so much for joining us today here at NDTV Profit, and letting us know about what the company is looking like for the next fiscal year. Wishing you all the best and look forward to our next conversation.
Thank you.
Thank you so much.
Well, that's all the time we have on this edition of Earnings Edge. Stay tuned to NDTV Profit for more.